You know that feeling when you're looking at a huge stack of complex information? Maybe it's a dense financial report, a pile of research, or just a mountain of notes, and you wish someone could just cut through the noise and tell you what really matters. Well, that's exactly what we're trying to do today on The Deep Dive. Today we're taking a deep dive into the latest Form 10Q from MercadoLibre, Inc., the behemoth of e-commerce and fintech in Latin America. Our mission to basically extract the most important nuggets of knowledge from this detailed financial filing. This one's for the period ended June 30, 2025, and give you a shortcut to being truly well-informed about this, fascinating company. We're going to unpack their recent financial performance, look at significant strategic moves across their vast ecosystem, and how they're navigating the unique economic landscapes of Latin America. Think of this as getting the critical insights you need with some surprising facts thrown in without feeling overwhelmed. This is the official word, right, directly from the company itself.
Exactly. We're pulling all of our insights directly from MercadoLibre, Inc.'s quarterly report on Form 10Q. It was filed with the SEC on August 5, 2025, and it covers the quarter that ended June 30, 2025. It really is the definitive source.
Okay, let's start unpacking this by just trying to grasp the sheer scale of MercadoLibre. I mean, the company calls itself the leading online commerce and fintech ecosystem in Latin America.
Oh!
That's a pretty bold statement.
It is, but when you look at their reach, it really holds up. What's truly impressive is their geographic footprint. Their e-commerce platform, the MercadoLibre marketplace, is incredibly widespread, operating in 18 countries.
18? Wow.
Yeah, stretching from Argentina all the way north to Mexico and including, the big markets like Brazil, Chile, Colombia, and then their fintech platform, Mercado Pago, that's also substantial. Active in 8 countries, typically the larger economies in the region, like Argentina, Brazil, and Mexico again.
All right, so it's more than just a platform. It feels like a complete integrated ecosystem. On the commerce side, you've got the core MercadoLibre marketplace. This is where you buy and sell, almost anything. Most of those transactions are from third-party sellers, individual merchants or small businesses using the platform.
Right. But MercadoLibre also does some first-party sales, so they sell their own products in certain categories. But it's small, less than 10% of their total sales volume, their GMV. They even handle cross-border trade, allowing sellers from places like China and the U.S. to reach Latin American buyers.
And connecting all that is Mercado Envios. That's their logistics backbone, right?
Absolutely. It's essentially how they get things from sellers to buyers, and their network is incredibly sophisticated. Get this. Over half of their shipments go through their own fulfillment centers. Yeah. They also use what's called cross-docking operations, which basically means goods are quickly transferred between trucks without long-term storage. It speeds up delivery quite a bit. Plus, they have MELI places. These are partner stores for easy drop-off, pickup, and returns.
Convenient.
And the transport network itself is massive. Dedicated aircraft, trucks, thousands of last-mile delivery vans. Though most are operated by third-party carriers, it's still their coordinated network.
And if you're a seller wanting to stand out?
Then there's Mercado Ads. It's their advertising platform. Lets brands and sellers promote products both on and off the MercadoLibre platform. They use their huge amount of first-party data for targeted ads, product ads, brands ads, display ads, even video ads.
Okay. And what about things like cars or real estate?
That's MercadoLibre Classifieds, more for big-ticket items, vehicles, properties, services. There they charge a listing fee, not like a percentage of the final sale.
Okay.
It's all about providing this comprehensive suite of tools, which also includes Mercado Shops. This is like a digital storefront solution. Lets sellers create and manage their own online stores, but still use MercadoLibre's logistics, ads, payment services.
Right.
Now, here's a key strategic shift mentioned in the report. They're migrating Mercado Shops to something called Mi Pagina, which will be embedded right within the main marketplace. So Mercado Shops is a standalone thing. It's actually being discontinued by December 31st, 2025.
Oh, interesting. So deeper integration.
Exactly.
Yeah.
Points towards really pulling everything together.
That's a pretty significant change. And then, of course, we have Mercado Pago, their huge fintech platform. It started just for marketplace transactions, didn't it?
Yeah, originally, to make payments secure and easy on the platform.
Right.
But it's really blossomed into so much more. It's expanded its services way beyond the marketplace to third parties, too.
So what does it offer now?
Oh, a whole suite of financial services. You've got loans and credit cards, often for merchants and consumers who, maybe haven't been served well by traditional banks. They have an asset management product, lets users earn returns on their digital account balances, but the funds stay accessible, like a high-yield savings almost.
Okay.
And they've even ventured into digital assets, launched services in Brazil, Mexico, and Chile. Users can buy, hold, and sell certain cryptocurrencies right through Mercado Pago.
Wow. And didn't they launch their own digital currency too?
Yes, that's MercadoLibre. This is really innovative. It's a stable coin, basically their own digital dollar, pegged 1-to-1 with the US dollar. It's available in Brazil, Mexico, and Chile.
So what's the angle there?
Well, loyalty program members can get cash back in MercadoLibre, but beyond that, all Mercado Pago users can buy, hold, and sell it with no fees.
No fees.
No fees. It's a pretty bold step into, the future of finance for the region. It gives people access to a stable currency, which can be huge in markets that might see volatility.
Right, democratizing access. Okay, so we've got a handle on the incredible scope of their operations now. Let's talk about how all this actually translated into financial performance in Q2 2025, the big numbers.
Yeah, let's dig in. Looking at the top line, MercadoLibre saw really strong growth this quarter. Consolidated net revenues and financial income soared by over a third, reached nearly $6.8 billion for the 3-month period.
$6.8 billion in a quarter. Wow.
And that momentum carried through the first half of the year, too. Total revenues up around 35% overall compared to the first half of 2024.
Okay, so if we break that down for Q2, commerce versus fintech.
Right. So commerce revenues grew by nearly 30%, came in at about $3.8 billion. That was mainly fueled by a healthy 21% jump in gross merchandise volume, the GMD, total value of goods sold, and also higher flat fees they charge for smaller transactions.
And fintech.
Fintech was where the growth really popped. Surged by over 40% to nearly $3 billion.
40%.
Yeah, phenomenal growth. Mostly driven by significantly higher credit originations. They're lending a lot more, and a nearly 40% increase in total payment volume, the TPV.
Okay, top line growth, clearly very strong. But what about profitability? How does that look?
Good question. Gross profit for Q2 2025 landed at just over $3 billion, which is up from last year. However, the gross profit margin actually saw a slight dip. It went from 46.6% in Q2 2024 down to 45.6% this quarter.
Okay. So making more gross profit but slightly less margin on each dollar of revenue. Why was that?
That slight compression was mainly due to increased cost of goods, sold what they paid for the products they sell directly, and higher shipping carrier costs as a percentage of the revenues. Logistics isn't cheap.
Right. And further down, operating income.
Income from operations increased year over year, landing at $825 million. But again, the margin decreased. Operating income margin went from 14.3% last year to 12.2% this quarter.
And what drove that decrease?
Mostly driven by a big jump in the provision for doubtful accounts money set aside for loans that might not get repaid, also higher sales and marketing costs, and those rising costs of net revenues we just mentioned.
Now here's something that caught my eye. Despite that robust revenue growth, their net income for Q2 actually dipped slightly. Came in at $523 million, which is down just a bit from $531 million in Q2 2024.
Yeah, that's a really critical point. For a company growing this fast, seeing net income flatten or dip slightly isn't necessarily a red flag, but it definitely tells you something.
And this also meant a slight decrease in their earnings per share, basic and diluted.
Exactly. It really suggests they're prioritizing aggressive expansion and grabbing market share over maximizing short-term profit. They seem to be pouring capital right back into the business.
So the big question for investors, and for us analyzing it, is are these investments strategically sound? Will they pay off long-term?
Precisely. Looking at the cost drivers for Q2 helps paint that picture. Cost of net revenues and financial expenses jumped by over 36% to almost $3.7 billion. Mostly higher shipping costs, cost of goods sold, sales taxes, funding costs for the fintech side, and collection fees.
And that provision for doubtful accounts.
That was one of the biggest jumps, up over 53% to $690 million. And that's directly tied to a massive 57% increase in their credit originations, especially for credit cards and consumer loans. Shows just how aggressively they're pushing into lending.
Makes sense. More loans, more potential defaults to provision for. What about sales and marketing?
Those expenses surged too, up 47% to $751 million. A big chunk of that was higher online and offline marketing spend, but also a substantial 37% increase in their sales and marketing headcount, plus higher costs for their buyer protection program and chargebacks.
Hiring aggressively there, too.
And in tech as well. Product and technology development expenses saw a notable increase, over 23%, up to $567 million, driven mainly by a 16% increase in tech headcount and also higher accruals under their long-term retention programs, those LTRs.
And one side to stock price.
Exactly. Stock price goes up, those future cash payout obligations increase. General and administrative expenses also rose nearly 20% to $261 million. Again, headcount increased there about 15%, and higher LTRP accruals.
So costs are up across the board, really funding that growth.
Pretty much. Though, interestingly, they did have a $16 million gain related to the fair value of their digital asset holdings this quarter, which helped offset some G&A costs. Last year, they actually had a small loss on that line.
Right. Okay, so we've dissected the overall numbers.
Yeah.
But MercadoLibre is all about Latin America. Where is this growth actually happening geographically? They break it down by country, right? Brazil, Mexico, Argentina, and then other countries.
Yep, that's how they report segments. And Brazil is still the giant. It accounted for just over half, 51.1% of their Q2 2025 revenue. Commerce revenues there were up nearly 25%, driven by growth in both product sales and services. Fintech revenues also strong, up over 24%, fueled by credit and financial services income.
But you mentioned currency fluctuations earlier. Did that play a role in Brazil?
It did. It's a subtle but important detail. Despite that strong underlying growth, Brazil's reported net revenues in U.S. dollars were actually held back a bit by an 8.6% average increase in the value of the Brazilian real against the dollar during the quarter.
Right, so the real got stronger, meaning each real converted into fewer dollars when reporting.
Exactly. Highlights how currency moves can mask some of the underlying strength.
Okay, what about Mexico, second biggest market?
Mexico represented about 22.2% of Q2 revenue. Commerce revenues there increased by over 24%, mostly from higher services and product sales. Fintech revenues also grew significantly, up nearly 28%, driven by financial services income and credit revenues. Strong showing.
And the currency impact there.
Similar story, actually. Mexico's net revenues were also somewhat offset because the Mexican peso saw a pretty big 12.9% average increase against the U.S. dollar during the quarter.
Wow, 13%. So currency dynamics are definitely a key factor across the board.
Absolutely. A recurring theme you have to watch with Emili.
Now let's talk about Argentina, because those numbers look wild.
Yeah.
It's about 22.5% of Q2 revenue now, neck and neck with Mexico almost.
Yeah, Argentina's performance was incredible. Commerce revenues there just exploded, up a staggering 69.4%.
69%. How?
Primarily driven by a massive 45.9% increase in the number of successful items sold, plus strong growth in product sales value.
Okay. And fintech in Argentina.
Even more dramatic, fintech revenues increased by over 81%. 81%.
Good grief. What fueled that?
Largely a 31.3% increase in the number of total payment transactions. Financial services income and credit revenues were the big drivers there.
So how on earth did Argentina achieve such outsized growth compared to Brazil and Mexico? There has to be more to it.
There is, and it's fascinating. The report points to the unique economic situation. Argentina's average interannual inflation rate during the period was 43.4%, but the average interannual increase of Argentina's official exchange rate against the U.S. dollar was lower, at 29.9%.
Ah, okay. So local prices and revenues in pesos inflated faster than the peso devalued against the dollar.
Precisely. And because Argentina's operations have been classified as highly inflationary since mid-2018, they use the U.S. dollar as the functional currency for reporting. So when those inflated peso revenues get translated back to dollars at an exchange rate that hasn't quite kept pace with inflation, the reported dollar revenues look exceptionally strong.
So it's a mix of real operational growth and these complex macroeconomic dynamics.
Absolutely. It's a really compelling case study in operating in hyperinflationary economies. Shows the challenges, but also how they can navigate it and how it impacts the reported numbers you see.
Really interesting. Okay, and finally, the other countries segment. Smaller markets like Chile, Colombia.
Right. That segment includes Chile, Colombia, Costa Rica, Ecuador, Peru, Uruguay, and the U.S. operations. Altogether, about 4.2% of Q2 revenue. Here, commerce revenues increased by a solid 25.2%, and fintech revenues grew by a strong 33.3%. So healthy, broad-based growth across their smaller markets, too, not just the big three.
Okay, beyond the core financials, let's look at some key performance indicators, the KPIs. They give a good snapshot of operational growth.
Definitely. For Q2 2025 versus Q2 2024, fintech monthly active users jumped to 68 million. That's up from 52 million last year. Huge increase.
68 million active fintech users. and marketplace buyers.
Unique active buyers in the marketplace grew to 71 million, up from 57 million. And it's worth noting the report mentions that food delivery transactions are now included in these buyer metrics from Q2 2025 onwards, so that broadened the scope a bit.
Got it. What about the value and volume of transactions? GMV, items sold.
Gross merchandise volume, GMV, hit over $15.2 billion. That's up from $12.6 billion last year. Again, includes food delivery now. And the number of items sold also saw incredible growth. Hit 550 million items in the quarter.
500 million items.
Up from 421 million last year. Just massive scale.
And the fintech side, TPV, transaction count.
Total payment volume, TPV, hit an impressive $64.6 billion in the quarter, up from $46.3 billion. And the total number of payment transactions they processed, a staggering 3.6 billion.
Billion with a B.
Up from 2.6 billion last year. These numbers just underscore how deeply Mercado Pago is getting integrated into daily economic life across Latin America.
This is mind-boggling scale. Yeah. And achieving that kind of growth, expanding the network, that takes investment, right? Capital expenditure.
Oh, yeah. Significant investment. CapEx for Q2 2025 totaled $287 million. That's up substantially from $184 million in Q2 2024. Looking at the first 6 months of the year, they invested over $200 million in IT assets and a huge $290 million in shipping premises and offices, mainly in Argentina, Brazil, and Mexico.
So really doubling down on logistics and tech infrastructure.
Clearly a major priority, building out the physical and digital backbone.
Okay, operating at this scale across so many different countries with different currencies and economies.
Yeah.
There must be significant risks to manage. Foreign currency seems like a big one.
It's huge. They have massive operations denominated in foreign currencies, primarily the Brazilian real, the Mexican peso, and the Argentine peso. They do use hedging strategies, forward contracts, currency swaps to try and mitigate this risk, but it's always going to be a factor.
And the report gives a sense of the potential impact.
It does. They provide a sensitivity analysis, a hypothetical 10% adverse move in all foreign currencies against the US dollar over the first half of 2025. Could impact net income by somewhere between $140 million and $171 million. And total shareholder equity could swing by $537 million to $657 million.
Wow. So even with hedging, the exposure is still very significant.
Definitely. It's just the nature of their cross-border business.
Beyond currency, what about interest rate risk? They do a lot of lending now.
Right. Changes in interest rates affect the cost of funding their credit card receivables. That was about $6.6 billion at the end of June. And their loans receivable, around $6.9 billion. It also hits earnings on their investments and the cost of their variable rate debt, which was about $5.2 billion in loans payable.
And the potential impact there.
Their analysis suggests a hypothetical 100 basis point, that's 1% increase in interest rates, would increase reported charges to income by roughly $24 million for the 6-month period. Significant, but maybe less dramatic than the currency risk.
Okay. And you mentioned those LTRPs, the employee retention programs tied to stock price. Is that a risk factor too?
It's listed as an equity price risk, yes, because they involve cash payments tied to the stock price. As of June 30th, the total estimated fair value of the obligation for these outstanding payments was nearly $1 billion, $973 million.
Almost $1 billion tied to the stock price for employees.
Yeah. And here's the sensitivity. A 40% increase in their stock price could raise that obligation to over $1.36 billion. But a 40% decrease could lower it to $584 million.
So employee compensation costs are directly linked to market performance. Interesting incentive structure.
Very direct.
So with all these moving parts, growth, investment, risks, what's their overall financial health look like? Liquidity, funding.
Their main liquidity sources are cash from operations, selling off some of those credit card receivables periodically, and credit lines. As of June 30th, they had a very healthy cash cushion, nearly $4 billion in cash, cash equivalents, and short-term investments, not counting restricted funds.
Seems solid. How do they fund the lending specifically?
Primarily through securitization. They package up credit card receivables and loans into special purpose entities, SPEs, in Brazil, Mexico, Chile, and Argentina. These SPEs then issue debt backed by those assets. It's a common way for non-banks to fund lending efficiently.
But MercadoLibre often keeps a piece of those SPEs.
Yes, they often retain subordinated interests, meaning they take the first hit if loans go bad. Because of that significant interest, they usually have to consolidate these SPEs onto their own balance sheet. It adds complexity, but it's key to their funding model.
And do they have backup credit lines?
They do. They mentioned entering a $400 million amended revolving credit agreement late last year, but they hadn't actually drawn any money from it as of June 30th. Suggests they're managing liquidity well without needing emergency funds.
Okay, shifting gears slightly to the regulatory side. Seems like their fintech arm is always busy on that front.
Very active. In Argentina, one subsidiary got approved as an investment fund agent. Another took over managing their big Mercado Fondo mutual fund, which now has over $4 billion in assets under administration.
$4 billion in their mutual fund.
Yeah. And perhaps most significantly in Argentina, two other subsidiaries actually applied for a full banking license with the central bank.
Wow, becoming a bank, that's a big step.
Potentially game-changing if approved. Also in Argentina, another unit was authorized to issue up to $500 million in debt securities, another way to raise capital.
And elsewhere, Mexico, Chile?
In Mexico, they submitted a request to operate an investment funds management company, expanding their asset management footprint. In Chile, they applied for registration to execute cross-border transactions, broadening payment capabilities.
And the Meli dollar stablecoin needed regulatory approval, too.
Yes. The Bermuda Monetary Authority granted their Bermudian subsidiaries a digital asset business license for Meli dollar. It's conditional on meeting some pre-launch requirements, but it shows they're navigating the new world of digital asset regulation to push that forward.
Lots happening on the fintech regulation front. One last operational detail, the supplier finance program.
Right, the SFP. As of June 30th, they had about $474 million in obligations outstanding under this program. This is basically where suppliers can choose to get paid early by a financial institution, usually earlier than MALI's standard 60-90-day terms.
So it helps supplier cash flow.
Exactly. Helps the suppliers in their ecosystem while MercadoLibre keeps its own payment terms. It's a smart working capital management tool for everyone involved.
Okay, let's try and wrap this up. You've just unpacked the very latest from MercadoLibre's Q2 2025 financial report with us. We've definitely seen a company with truly robust revenue growth across both e-commerce and fintech. That performance in Argentina, given the economic climate, was particularly, well, eye-opening.
Absolutely. And it's clear they're making huge strategic investments back into the business logistics network, financial services expansion, all while, skillfully navigating those complex regional regulations and significant foreign currency dynamics we talked about.
So as you reflect on this deep dive, what really stood out to you? Was it maybe that incredible growth in Argentina despite the headwinds? Or the rapid, innovative expansion of fintech, like Meli dollar? Or just the sheer scale of their operational investment?
It's hard to pick just one thing, but maybe thinking big picture. Given MercadoLibre's aggressive, ongoing investments in building out not just their physical logistics infrastructure, but also these increasingly sophisticated digital financial services, how might this really multi-pronged approach redefine what an e-commerce company even is in Latin America? And maybe what unique competitive advantages or perhaps entirely new risks could arise from such a deeply integrated and geographically diverse strategy down the road?